This video will completely simplify your understanding of order blocks. Today, we will be going over the very basics of order blocks that is sufficient enough for your understanding and trading. There are a lot of different definitions of the order blocks out there. However, I guarantee you that today's teaching will simplify and remove any confusions you may have. First of all, what actually is an order block? Here we have an example of a bearish order block. Focusing on the left diagram, it is the last up close candle before a strong move down in the form of a displacement, and it gets validated after the low is taken. Now you would draw a line out from the open of the last up close candle as shown in the right diagram. That is your order block area. Price could then retrace to this area to mitigate any orders left behind before continuing in the higher time frame direction. In this case, it would be bearish, as this example is a bearish order block. The same concept applies here to bullish order blocks, but it is inverted now. So instead of the last up close candle, it is now the last down close candle before a strong move up, which gets validated after the high is taken. This shows that the selling has ended and the algorithm has shifted to a buy program. Again, you would draw out from the open of the order blocks as the bodies contain the bulk of the orders. Now, there is another form of order blocks. This occurs when you have consecutive candles. So looking at the left diagram, it is a bearish order block, but notice the consecutive bullish closed candles before the strong displacement lower. You could take the entire range to be your order block, as it is just one large order block on a higher time frame. It's very important to remember that the candles have to be consecutive. There can't be a disruption in the consecutiveness. If you don't understand what I meant by that, don't worry, I will go over this in more detail with the live examples. And if you look at the right diagram, this is a bullish order block. So, like I said, you draw out from the open of the consecutive range, and that becomes your order block range. So here, if we play price out, you can see that there's this bearish candle that gets formed, and price is showing a bullish reaction off of it. So this could potentially become your order block if price takes out this high with heavy displacement. Right, it takes out that high with heavy displacement. Now, this validates your bullish order block. So here, if we draw out from the open and use the body of the bearish candle, and once it retraces back into this order block range, you could expect it to continue higher in its intended direction. So here, like so. In the process of doing so, you can see here that we created another bullish order block in the form of the consecutive bearish candles. Here we only had one bearish candle, which was the first form of order block that I showed you guys. However, here we have 3 consecutive candles. So notice how all the bearish candles are directly next to each other. There's no disruption. There's no bullish candle in the middle of these 3 candles, because then that would not be consecutive, would it? Marking that out, price validates it after it takes out that high. This becomes your bullish order block range. So let's play price out. We could expect it to retrace back into this order block range to mitigate any orders left behind before it continues higher. Again, another bullish order block is formed. Price doesn't retrace back into it, and that's fine. You can see here that along the way, further order blocks are formed in the form of a mitigation block, which is also a type of an order block. But as this is the basic teaching of order blocks, we won't be going into the specific, and we'll just be touching on the surface level. So here, this is also another order block, right? Price retraces into it and breaks it. That's fine. Now we could expect a trend change after it took out this low. So now that becomes your market structure break. And if you play price out, you can see here that here we have a bearish order block. The last up close candles followed by a heavy move down, that becomes your bearish order block. And you see here, when I mentioned consecutive, if this bearish candle printed bullish, then you would use the entire range here. You would use all 4 candles. However, since there's a disruption in the candles, this was a bullish and then this was a bearish candle, you would only use the 2 bullish candles after the bearish candle, because they are the only 2 last up close candles that are consecutive, aka right next to each other. So price doesn't retrace into that order block, that's fine. We create another order block. Price just about mitigates, and do you see how precise that tap was? So if we play price out, it continues lower after retracing back into that order block. And that is pretty much all the fundamentals you have to know about the order block. Don't try to overcomplicate it with different definitions and try to find every single reasoning for why price retraces back into this order block or it doesn't, right? All an order block simply is, a bearish order block is simply the last up close candles followed by a strong move lower. And a bullish order block is simply the last down candles followed by a strong move up. That's all it is. And from there, you could anticipate price to retrace back into them to mitigate any orders that are left behind. And you could use that either as your entry or as your high time frame PD array. So if we look at more examples, these 4 consecutive candles was formed as a result of retracing back into this order block above. It then becomes validated after this low gets taken out. Now, there's one thing I want to point out with consecutive candles. How big your range is very subjective. Because say you entered off here, order blocks is a valid entry pattern, right? Say you entered off there like that, your stop loss would be very large. However, if you refine it to half of the candles, your stop loss gets significantly smaller and your original target would provide you with a higher risk to reward ratio. But the downside of this is you're less likely to get tapped in. Whereas if you used all 4 candles, chances are you get tapped in, right? And then price continues lower. If you refine it to that, yes, you get a higher risk to reward ratio, but there's also a less chance of you getting tapped into your entry. So make sure with consecutive candles, backtest and see which one fits your trading personality the most. So some people would want to use the entire range, some people would just refine it to half of the range, or you could even use 1 candle. That's like a sniper entry. Trading is not perfect, so you don't always have to have sniper entries all the time for your trades, right? Now that you are familiar with the basic concepts of order blocks, there are 2 main simple ways that makes an order block high probability. And that is when it forms of a high time frame PD array and when it sweeps liquidity. Let's look at a few examples to show you what I mean by this. Right, so here, on a weekly time frame, which is your higher time frame, price is in a bearish trend, and after it takes out this liquidity, so let's mark that out as sell-side liquidity, you would expect price to come back and rebalance an old inefficiency. So, where are your inefficiencies? Here and here. If you don't know why price comes back to rebalance an old inefficiency, I recommend you guys watch our daily bias video. But in short, price has 2 functions. 1 that is to seek liquidity and 2 rebalance old inefficiencies. So now that it's seeked liquidity, price will now come back to rebalance an old inefficiency. And that is in the form of these 2 imbalances. So let's play price out. That was a lag there, but let's go down to daily. Price taps into that imbalance and let's see if it gives us an order block. Our anticipated order block range is this. Alright, so this is a very special scenario. Instead of this initial order block getting validated, we come down and then we have a minor retracement up before it continues lower. If you look here, this intermediate term low was created in a small retracement higher. And then price showed a strong displacement down, taking out this intermediate low. That becomes your market structure shift. So instead of using this initial order block, you would then use the order block that was created in a minor retracement leg before it continues lower. Because this was where your displacement happened. So playing price out, price taps into that order block range. And here you would expect it to go lower to follow the higher time frame direction. Because on the higher time frame with bearish, price comes back into this higher time frame PD array in the form of an imbalance. And then on the daily, your last 2 up close candles followed by strong displacement lower, taking out this intermediate low, creating a market structure shift. That becomes your high probability bearish order block. And when price retraces back into this order block, you would expect a move away from it in a bearish direction. And this would be your next strong liquidity, which it hits. And that is what I mean when I say when an order block forms of a high time frame PD array, that makes it high probability because it's backed by the high time frame direction. Here we have another example of a high time frame PD array. On a weekly, this is a volume imbalance, so price could retrace into this before continuing lower and continuing the bearish trend. Just about taps into it. This could be your anticipated order block range. Let's see if it validates it. It doesn't validate it. Instead, it takes out that high, and then this becomes your new order block range. Let's see if this gets validated. Again, no validation, and it takes out the high again. But we are still playing within this volume imbalance range, so it's still valid to hunt for order blocks. Notice the difference here. This high stays intact after taking out these two highs, and it shows a heavier displacement lower, taking out the open of this order block range, validating this bearish order block. Now you would anticipate price to retrace into this and continue lower, or it doesn't have to retrace, but this order block would ideally stay protected because there's a high probability order block in line with your higher time frame direction. So price doesn't retrace into that, fair enough, but you can see how important the validation of the order block is. If you was quick to hunt for order blocks here, right, if you anticipated this order block to form and this order block to form, you would have lost out twice because this high got taken out and this high got taken out. There was no validation for the order block to form. Yes, it seems like an order block is forming, but if the low doesn't get taken out, then the bearish order block becomes invalidated. It never becomes validated. Compared to this bearish order block, that low got taken out, it validates it with a strong move down. So if we play price out now, leaves behind an imbalance. Let's go down and see if it provides us with a high probability order block. The bodies are not closing past this imbalance yet, so it's still valid. So here, these 3 consecutive up candles becomes your, let's remove this for now. This becomes your bearish order block after this low gets taken out, which validates it. And then price moves away after retracing back into this high probability order block. And this could become your next draw. And then it takes out eventually. And that is your high probability order block formed off of a high time frame PD array in the form of this imbalance. Alright, so here, this is an example of its liquidity sweep. So here we had these highs in the form of buy side liquidity. Price sweeps them buy side liquidity, right? And if we play price out, it shows a heavy move down. So if you mark out the last 2 up candles, that becomes your high probability bearish order blocks. Why? Because it has swept buy side liquidity. So this high that swept it becomes your high resistance liquidity. Ideally, this should be protected if price wants to continue lower, because there's minimal liquidity left for price to come back and pair their orders with before taking it lower. So this becomes your high resistance liquidity. And if you look here, this is your low resistance liquidity because there's a trendline liquidity. So price could just slice through it very easily. So let's play price out and see what it does. Alright, so price fails to take out this sell side liquidity and is showing a heavy displacement higher. Ideally, this bearish order block should stay intact because there's high probability, right? It was formed off of a liquidity run, making this high resistance. Price breaks through that order block, and now you can anticipate for this high to go because there's no reason for price to break through this order block if it is high probability, unless it wants to continue higher and take out this high. And that was what we had there. This is another example, but with a bullish order block. Price takes out these relatively equal lows. That becomes your sweep. And then it displaces higher, making this consecutive bearish candles your high probability bullish order blocks. So you would draw it out and you would anticipate price to either retrace down here and continue higher, or not close past of this order block because it's high probability. So here price doesn't retrace back into it, fair enough, but it continues higher because this is a high probability order block. So the most important thing is it shouldn't get violated. Same thing here. We have another sweep. This becomes your high probability order block. Price retraces into it. And it has further expansion. And that concludes the second way an order block could become a high probability order block. The last concept I want to touch on is mean threshold, which is essentially just the 50% level of your order block range. So you might be wondering, what's so important about the 50% level? Well, price is very sensitive here, so ideally you wouldn't want a body closure past this level if you're anticipating the trend to continue. If the body closes past it, it would make your order block low probability and you would anticipate the order block to fail. If you have a look here, we are anticipating a bullish order block. Price validates that order block and then retraces back into it. So here we play it out and then we mark the 50% level. Notice how we get no body closure past this 50% level. We can anticipate this order block to hold and then it expands higher. Same thing here. Order block, we mark out the 50% level. Price doesn't close past this 50% level with a body closure, and now we can anticipate higher price action. And if you look at this example, price validates this bearish order block. If you mark at the 50% level and play price out, it has a body closure past this 50% level. So you can anticipate this bearish order block fairly. So let's play price out. And then it trades through it. Paired up with the fact that we're in a bullish trend, so any bearish order blocks should ideally give away anyway. But this mean threshold is an early indicator of it failing. You see that? Body closure past this 50% level. And that pretty much concludes this video on the basics of order blocks. I hope you guys found this video helpful. If you have any questions, feel free to leave them below in the comments. Or any future videos you would like to see, then feel free to suggest them. Like always, please like and subscribe, and take care.